The federal budget is on track to be in surplus for a second successive year. The used car market has well and truly peaked with prices on the way down, and the United Nations climate change meeting reaches an agreement. Almost. Welcome to Fear and Greed Business News, Australia's best business podcast. It's Thursday, the 14th of December 2023. I'm Michael Thompson, and good morning, Sean Aylmer.
Good morning, Michael.
Sean, after the show, you are speaking with Sarah Bratton-Hughes, Head of Sustainable Investing at American Century Investments.
Yes, all about the COP28 conference and what's going on in terms of investing in ESG and climate change and those sorts of things. We have a good chat, very timely, given what's happened in the past 24 hours over there in the UAE. So we have a chat about what it means for investors. Sarah comes to us from New York, so she has a very global perspective on it. Well worth a listen, I would say, Michael.
I completely agree. She knows this space so well. It is very much worthwhile listening. It's coming up after the show. The main story this morning, Sean, a big jump in tax revenue thanks to higher commodity prices and a stronger than forecast employment market, and a delay in infrastructure spending has put the federal budget on track for a second successive surplus.
Yes, the mid-year economic and fiscal outlook released yesterday by Treasurer Jim Chalmers updates the bottom line for this financial year from a $13.9 billion deficit forecast back in May to a balance, or in fact a tiny deficit of $1.1 billion. And that's mostly because of a surge in tax revenue of $65 billion more than we thought back in May. That's over the next 4 years. Chalmers said the government isn't forecasting a second successive surplus, but he did say it's within striking distance. To help lower inflation and help pay down debt, Dr. Chalmers says the government is banking 92% of the revenue windfall. Now, the big jump in revenue reflects an extra $30 billion from income taxes over the next 4 years and $35 billion more in company receipts. Income and tax revenue will improve the bottom line this financial year by more than $18 billion. While income tax reflects the employment market, the company tax receipts is mostly about the big three miners and the fact that iron ore prices are still high, or at least relatively high, much higher than Treasury forecast previously. There's also more money from hiking up passport fees and an increase in taxing of foreign real estate purchases. Businesses will also no longer be able to tax deduct the interest charged on overdue debt to the Australian Taxation Office. On the savings side, there's a windfall of nearly $10 billion, though about 3/4 of that is because projects have been pushed further out, so that don't make it into the 4-year budget timeline.
Hang on, so claiming the interest charges on an overdue debt to the tax office will no longer be a tax deduction. That feels a bit cheeky in the first place to try and claim that.
Yeah. The argument is that it's a bit fairer. Well, who's going to argue against that? I don't know why it was ever tax deductible.
I quite enjoy that. Now, what about the economic forecast, Sean?
MyFO predicts that the consumer price index will fall to 2.75% next financial year, back within the target range of the Reserve Bank of Australia. The Treasury forecast on inflation is just a bit more optimistic than that of the central bank, which expects inflation to stay above the target until late 2025. Economic growth, 3.1% last financial year. Treasury reckons it'll slow to 1.75% this year. Mind you, that's an upgrade from 1.5%, which it forecast back in May. Surging revenues means gross debt as a share of GDP will now peak at 35%. In 2027-28, that's a little bit lower than what the previous forecast was. Good news there. Despite the improved debt position, the increase in long-term bond yields since May means the debt interest bill is forecast to be the federal government's fastest growing expense, overtaking the National Disability Insurance Scheme.
Sean, I am so glad it's you wading through the MyFO documents and not me.
It's better than the budget documents. MyFO is really small and contained. It's kind of easy. Budget documents, not so much.
So suddenly compared to that, you're just like, this is a walk in the park.
Walk in the park.
A relative walk. Now, local markets, how did they perform yesterday?
The S&P ASX 200 closed up 0.3% to 7,258 points, another near 3-month high, with healthcare stocks leading the way, while real estate investment trusts and financials also did well. Energy stocks, once again, were the weak performers. CSL was among the best performers of the large caps, up more than 1%. All the banks did pretty well. It was a big day for the iron ore miners. As we were just discussing, the price of ore remains high, about $135 a tonne. That's pushed Fortescue Metals Group's share price to a record high and Rio Tinto's share price to a 2-year high. Woodside and Santos were lower, Telstra was down, and retailers Woolies and Coles also underperformed. In corporate news, Air New Zealand dropped 1% after it downgraded guidance on weak demand. Well worth mentioning the gold miners, Newmont and Northern Star, dropped around 1% as the price of the precious metal slipped below $2,000 an ounce.
And what's happening in international markets?
It was all about the US inflation figures, which show annual inflation in the world's biggest economy falling slightly to 3.1% last month. But core inflation, on an annualised basis, was unchanged at 4%, still double the Fed's target of 2%. The upshot of all that is that while investors don't think the Federal Reserve is about to raise interest rates again, they may stay higher for a while yet. Certainly US bond yields rose and Wall Street was happy with the inflation outcome, with the S&P 500 closing at a year-long high. Away from equities, oil prices fell further, with Brent crude down below $73 a barrel. Gold is off, as I mentioned a moment ago. It's trading around $1,980 an ounce, and the Aussie dollar is buying 65.6 US cents.
Okay, we'll be back in a moment with the rest of the day's business news. Sean, Prime Minister Anthony Albanese and his counterparts from Canada and New Zealand yesterday issued a joint statement criticising the actions of both Israel and Hamas amid escalating bloodshed in Gaza, and called for a ceasefire and the release of the remaining Israeli hostages.
The unprecedented communique between Albanese, Canada's Justin Trudeau, and New Zealand's Christopher Luxon condemned the October 7 terror attacks in Israel, said Hamas must lay down its arms and stop using Palestinian humans as shields, and also said Hamas should play no role in the future governance of Gaza. At the same time, they cautioned Israel against the wanton destruction and deaths and any attempt to forcibly displace more than 2 million citizens from Gaza and reoccupy the territory. Along with the UK and US, the three countries are part of the Five Eyes Intelligence Alliance. Early yesterday morning, Trudeau conveyed the sentiments to Israeli Prime Minister Benjamin Netanyahu in a long phone call. The statement follows a warning by US President Joe Biden that Israel is losing international support because of its indiscriminate bombing of Gaza.
And Sean, Australia is also part of a world call for an immediate humanitarian ceasefire.
That's right. Yesterday morning, Australia voted in favour of a United Nations motion calling for a ceasefire and the unconditional and immediate release of the remaining hostages. The vote passed with 153 countries voting in favour, 10 opposing, including Israel and the US, 23 abstained. The vote came notwithstanding the Security Council, which is the part of the UN that's responsible for global peace and security, not making such a call. Now, that's all about the US's veto powers. The latest vote is non-binding, but certainly highlights what I just mentioned, that Israeli Prime Minister Benjamin Netanyahu is losing support globally.
Now, Sean, I reckon there'd be a few Sigma shareholders pretty happy today, with the stock share price jumping 70% yesterday morning after it resumed trading following the announcement of its merger with Chemist Warehouse. It eventually finished 36% higher, still grounds to be reasonably happy, I would say.
Yes, particularly since Sigma has been an underperformer. But I'd say most shareholder is just a little bit happier this Thursday morning. Sigma completed a $400 million raising before reopening to trade. Under the deal, of course, Sigma will buy the much bigger Chemist Warehouse to create a near $9 billion wholesale and retail pharmacy business. If approved by the competition regulator, and there's an if in that one, the proposed ASX listing will own 864 pharmacies in Australia, split between 503 under the Chemist Warehouse brand and 361 under the Sigma brand, with equivalent earnings before interest and tax of just about $500 million on sales of about $6.7 billion.
Sean, we've been doing this podcast now for, 3.5 years? Is it? And I reckon every couple of months there is a story about used cars, because we have seen the extraordinary kind of boom in the value of used cars. So I'm really interested in this story. The average time to sell a used car in Australia has blown out to its highest level now in 12 months, unwinding almost 4 years, as I mentioned, of boom times in the second-hand vehicle market.
Supply chain backlogs for new vehicles are clearing as car manufacturers step up deliveries to buyers previously waiting more than 6 months, while cost of living pressures means some households are delaying purchases of a used vehicle. That's according to a report in the Financial Review. A new report by the Australian Automotive Dealers Association, which oversees the interests of 3,000 new and used car dealers, has found the average time it takes to sell a used car is now 52 days. This compares with almost 43 days at this time last year. The report, compiled with vehicle data company AutoGrab, says used vehicles make up about 2/3 of all cars purchased in Australia. In November, there were more than 300,000 vehicles listed for sale, and just a little over 200,000 were sold across private sellers and dealerships. Used car prices are gradually coming down too. Moody's Analytics said in mid-2022 that used car prices were on average 80% higher than at the start of the pandemic. That has reversed now, though.
Okay, now in international news, a new draft climate agreement released at the COP28 climate summit in the United Arab Emirates yesterday has for the first time explicitly called on nations to transition away from fossil fuels to avert the worst impacts of the climate crisis.
But the latest proposed text released by the COP President Sultan Al Jaber yesterday did not include an explicit commitment to phase out or phase down fossil fuels, as many countries, civil society groups and scientists have urged, according to a report in The Guardian. Instead, it called on countries to contribute to global efforts to transition away from fossil fuels in energy systems in a just, orderly and equitable manner, accelerating action in this critical decade so as to achieve net zero by 2050 in keeping with the science. The release of the proposed compromise followed 36 hours of negotiations after Al Jaber released a draft which was roundly rejected by rich and poor countries, who described that one as grossly insufficient, incoherent, and a death certificate for low-lying and vulnerable nations. Anyway, as Chris Bowen put it a couple of days ago, it's somewhere between a step forward and a step ahead.
Now, we are long overdue for an Elon Musk story. We used to have an Elon Musk story almost every day, really, just because he was just delivering so many headlines.
3 times a week.
Yeah, that's right. But this is a cracker. Revenue at X, of course, formerly known as Twitter, probably best known as Twitter, has tumbled since Elon Musk bought the social network platform for $44 billion.
Yes, perhaps not his best investment. X is on track to bring in roughly $2.5 billion in advertising revenue this year, a big drop from prior years, according to a report on Bloomberg. X generated a little more than $600 million in advertising revenue in each of the first 3 quarters of the year and is anticipating a similar performance in the current period. That compares to more than $1 billion per quarter the previous year, back in 2022. Ad sales currently make up between 70 and 75% of X's total revenue. If you add in turnover from subscriptions and data licensing, it kind of suggests that 2023 sales will come in at about $3.4 billion. The year before Musk took over, it made revenue of $5 billion. Ouch.
Do you think Elon Musk is regretting his words to the advertisers who left the platform? Didn't he tell them basically what they could do to themselves?
You wonder whether he cares. I mean, he's worth $200 billion. I don't know.
You know what? He strikes me, though, as one of those people that in the end, the money doesn't matter. He just wants to win still.
Yeah. Yep. I agree with that. Totally.
Now, Argentina, Sean, has announced a sharp devaluation of its currency and cuts to energy and transport subsidies as part of shock measures new President Javier Milei says are needed to deal with an economic emergency.
Very interesting economy, Argentina, at the moment. The peso will be devalued by 50% to 800 to the US dollar from 400 pesos, according to a story on Associated Press. Milei said the country doesn't have time to consider any other alternatives. Argentina is suffering 143% annual inflation. Its currency has plunged, and 4 in 10 Argentines are impoverished. As part of the new measures, the government is cancelling tenders of any public works projects and cutting some state jobs to reduce the size of the government. There's also cuts to energy and transport subsidies, and the number of government ministries will go from 18 to 9. Very, very drastic measures, but they're needed.
All right, up next is the Fear and Greed Daily interview. Your guest today, Sean, is Sarah Bratton-Hughes, Head of Sustainable Investing at American Century Investments, joining you from New York.
Yes, all about COP28. Very, very timely discussion about what's gone on over the past couple of weeks in the UAE and what it means for investors.
Yeah, it's a really good chat. It's up next in the Fear and Greed playlist on your podcast platform or at fearandgreed.com.au. Thank you, Sean.
Thank you, Michael.
It's Thursday, the 14th of December 2023. Please make sure you're following the podcast, and you can join us online as well on LinkedIn, Instagram, X and Facebook. I'm Michael Thompson, and that was Fear and Greed Business News. Have a great day.